Good afternoon. Actually, Happy New Year. How's everybody doing? This is Craig Modelmog with this week's episode of Wall Street X's and O's. I missed you guys, but I tell you what, I hope everyone had a wonderful Christmas. Happy Hanukkah, Happy New Year, all the good stuff that this time of the year brings. I know that I did. And looking forward to the new year. I'm always excited. My glass is always full. I always say, you know what? Are you a half glass full type of person, or half glass empty? I'm a full glass type of person. So I'm excited for the new year. I can't help it. It's going to be a good year. And you know what? We can't help but be positive. That's the name of the game today. But anyway, kick things off. We have the regular disclaimer where the thoughts and opinions on this show are just that. They are mine. They are not meant to be a solicitation or an offer to buy or sell any security, any investment product, any accounting advice, any legal advice. Securities can and will lose money. They are not FDIC insured. And without further ado, we're going to kick this out. I got a good show today. I've been saving up the last couple weeks, and I appreciate everyone letting me take last week off, as it would have been kind of, I could have filmed it at home, but I was hanging out with my kids and having a great time. And so I appreciate everyone cutting me some slack. But got a good show. Today we're going to talk about the base effect and mean reversion and really what it all means. We're going to talk about the real state of the union. That means related to growth and inflation. And I'm going to close it out with some fun facts to kick off the new year. These are doozies. That's all I can say. They are doozies. So anyway, what's the base effect and why does it matter? What the base effect is, it's a way of choosing different reference points when we compare things. Specifically from a numerical standpoint or a statistical standpoint, you're always comparing. Me, as you know, many of you know, I played quarterback in college, and they always compare. How did you do one game to the next? How did you do last year to this year? How did you do playing against the Pitt State Gorillas last year versus the Pitt State Gorillas this year? We always did terrible, by the way. But it gives us a reference point. So when you look at growth and inflation, particularly GDP and CPI growth, it's a really good way to see how things change, because in the end, when you're really analyzing year-over-year growth rate changes, which is what is normally the reference point when looking at CPI, which is inflation, that's how much things go up or down in value, and GDP, which is growth, gross domestic productivity of the United States. Is the economy growing? Is the economy not growing? They usually use a 1 year year-over-year look back. Okay, I utilize that. I also, because of COVID, have used a 2-year look back, especially when it comes to earnings and stuff. Because let's face it, 2020 was a disaster. One of those that you look at things going, seriously, lots of crazy numbers. But anyway, when you do a 1-year look back, specifically, we're going to focus on economic growth, okay? If you go back to the second quarter of 2020, okay, that is massive pandemic shutdown, economy falls off the cliff, bang, okay? When you look at second quarter of 2021, massive snapback, okay? Again, comparing the same quarter from 1 year to the next, you get that rate of change. And what does that look like? Now, you say, well, duh, Craig, yeah, that's what you expect. Well, but would you use the question? It even gets bigger, or takes on a little bit bigger meaning when you look historically. If you look back the last 10 years, okay, on GDP, not a lot of change. It's more or less a very stationary process. So when you have massive dislocations in the market, both to the downside and the upside, it's important to track these rates of change to really give you a feel for what's going on in the economy, okay? When you look at CPI, which is inflation, same thing. We had a massive deflationary environment going back into, Q2 of 2020. We've seen a massive inflationary move here. Well, you would expect that. When you really think back and go, oh yeah, it's that river mirror mentality. You would expect that. What's going to be interesting, though, as we move forward, how do these numbers change? Do things continue to accelerate? Do they begin to decelerate? And at what rate do they decelerate? That becomes key, because that's what you have to focus on when you're really gauging the expansion or the contraction of the economy is what is the velocity of that contraction or expansion? Because that really helps me anyway get a better idea of what we need to do moving forwards. So let's move on. Real State of the Union. This is some interesting stuff here because you don't see a lot of this out in the news. And as many of you know who follow me here on a regular basis, you know I try to focus on the points that have significant meaning that aren't getting touched on in the media, which can be a lot, okay? But I try to really focus on the ones that, to me personally, are going to be valuable for you to have a better understanding of what's going on. So if you look back, sometimes you have to look back to look forward, okay? If you look back at Q4, we were in an environment where we saw growth from an economic standpoint accelerating, along with inflation accelerating, all right? They finally got the inflation call right. It took them forever, but they finally got it right. Says, wow, this isn't transitory. This is a really big deal, and it's something we need to pay attention to. Now they're getting all goofy with it, and I'm going to talk about that before I close out for the day. We also saw in the fourth quarter of 2021 global inflation accelerate. This was on a global standpoint. So a global landscape, you saw a global inflation accelerate at one of the faster rates than we've seen in a long time, okay? Now, let's fast forward to Q1 and Q2 of this year on what the data is starting to look at. What we are seeing data-wise, and I've told this to many people, and I kind of get the roll of eyes, yeah, sure, Craig, whatever, you know, things are going up. That's the narrative that we only hear. Is that inflation's going up, 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 oh, this is terrible, oh my gosh, you've got the Fed. You know, they just showed the Fed minutes or came out with the Fed minutes, which what that means is every time the Federal Reserve body or group of governors meets as a group, they basically distribute those minutes that gives us a little deeper dive into what they were talking about and what they think. And that's kind of what blew the market up this week, is because the Fed, while last month in December was talking about 3 rate hikes to slow inflation and slow economic growth in 2022. Well, now they're talking about 4. When the market saw that, went right down the toilet and been, you know, it hasn't really recovered this week. It kind of threw a shock into the system, and the markets really haven't recovered. And that's equity markets and bond markets. We've seen equity markets sell off, particularly those leaders, which were groups specifically tech. Tech's gotten smoked this week, actually for the last about 8 to 10 days. So you're seeing leaders now really get hammered. And I think we're starting to see this change of the guard and leadership in the economy, which I'm going to get deeper into. So as I look at the numbers now, we're seeing growth, which is going to reaccelerate in Q4, which hasn't come out yet, but I've been talking about that for weeks now. We're going to see it peak. Basically, it peaked in Q2. We know that. Kind of took a dip, came back up. Now it's rolling over again. And we're going to be experiencing an environment where the landscape is economic growth is decelerating along with inflation. You say, wait a minute, Craig, inflation? Are you kidding me? Well, here's what is happening. Oil prices are come down. Natural gas prices have gotten destroyed. You're seeing fertilizer prices. Whenever you see a decline in energy prices, what usually follows is a decline in fertilizer prices, which then you know what usually happens? A decline in the softs or food prices. So does everything decline at the same time? No, just the same way when inflationary periods are going up in inflationary values, it's the same going down. It starts gradually and then begins to expand. The data right now is saying that we are going to experience a time where we're going to be in a deflationary environment. Now, don't think that it's going back down to what it was before. I'm not saying that. I'm saying over the next couple quarters, we are going to see growth slow along with inflation. And you could look at that and interpret that in 2 ways. You'll see some people or hear some people go, wow, that's really bad. Economic slowing is bad. Well, it depends, again, the velocity of that economic contraction. Well, this is not going to be any major economic contraction, all right? We're still dealing with COVID. We've got this Omicron or the Omicron, whatever you want to call it, variant that's going berserk right now. I think 1 out of every 4 tests is coming back positive. I know here in Colorado, as well as most parts of the United States, I know personally more people that have contracted COVID in the last 2 weeks than I ever did before. I don't know where you guys are all sitting on it. In fact, we had a COVID scare in my family. You know, you think your kids when they're in kindergarten and in grade school, they bring all the garbage home from school. Well, you know, one of my kids brought some stuff home from college, you know, bless them. But thankfully nobody had it. But we had a little interesting period of time when it was like, holy cow, you know, I really don't want this for a second time. I rode this merry-go-round once. I do not want it twice. Thank you very much. But anyway, so we're still experiencing that, which also has its economic impacts. But what I'm more keyed in on here is the Fed, because if the Fed is talking 4 rate hikes, I don't want to make it look like I'm 8 here. I would confuse you. If I'm an official signaling the number, this would be 44 had the illegal use of the elbow. We're not doing that. So this is just the deal. I got to get it back in here. I kind of started going off the basketball route, which this is hoop season. My Jayhawks are tough, and I got off track. I'm getting back on track now. In fact, I'm going to take a little drink, take a breather. Okay, I'm ready now. Here we go. If the Fed is predicting 4 rate hikes, one, that would be catastrophic. And you heard it from me here, maybe first. Here's why. The data is showing that we have an economy that is beginning contraction, albeit mild. We are also watching inflation contract, albeit mild. If you throw in a Federal Reserve that looks at this and makes a mistake, and they get into this happy rate hike environment, Powell already did it once. If you go back to 2018, at the very end of 2018, when the market took a poop right around December-ish, okay? That's because he was trying to raise rates, and God bless him, he actually was trying to accomplish the right thing. He just did too much too fast, and the market flipped out, the bond market flipped out, markets crashed. I mean, it was a disaster. It was like, wow, you took a pretty decent year in the market, and it all just went down the tubes in a second. So that's what I'm more focused on and worried about. If the Fed gets into this happy, wow, inflation is nuts. Again, how do they, what gives them their inflationary gauge? It is lagging. I couldn't think of lagging, man. It's lagging inflationary indicators. That's why they're always a year behind whenever they say, we're in a recession. Yeah, it happened a year ago. Or we're out of recession. Yeah, that happened a year ago. And that's legit. I'm not being sarcastic there. They focus on lagging indicators. So if the Fed continues their path on focusing on lagging indicators, which they will, because they've been doing it for decades. The only one that didn't was Paul Volcker, and he was the one in the late 70s and early 80s, for those of you that were alive and functioning back then, when inflation was through the roof, interest rates were through the roof, and whatnot. He's the only one that had the guts to really make a hard call and pull the reins back on that bad boy. We have not had a Fed chairman in that seat since have the guts to do it. So back to my point, should he get all interest rate raise, that doesn't even make any sense. So he gets all raising interest rates happy, okay? It could get very, very dicey, because anytime you raise rates into an economic contraction along with inflation going down, that is the recipe for a cluster. And I'm not going to finish the rest of that sentence. So if you look at what I'm watching, that's what I'm keying in on. I'm going to be very, very, very intently focusing on the language of the Fed and how they're positioning and posturing moving forward, because that is going to be critical as we move into the year here. Should he not get goofy? I think the market's already priced in one Fed rate hike already. I think it's already priced in one. Wouldn't shock me if we get it here soon, meaning today's the 7th of January. Could be this month, maybe next month, okay? If that happens, I think the market won't really blink at it because it's already built in. Now, going forward, it's going to be really crucial to see. And then also with that in conjunction with what is the velocity of the contraction, that's going to get interesting. So I'm already been positioning away from more of the high octane parts of the market, which is small caps, which is tech, which are those areas that like to churn and burn when the economy is healthy, and repositioning into quality, focusing on dividends, focusing on dividend growth, focusing on high quality bonds, treasuries. I started buying treasuries again this week. Those are things you start to focus on as you enter in a period of time when you do see contraction. How much do you get into that also depends on how quick or how that velocity component picks up one way or the other. So it's going to be fun to watch. All right, I don't want to create a lot of fear out there, but there's some pretty key things that we're going to keep our eyes on. Okay, all right, kicking this off here, or actually closing it out here. We're going to close it out with some fun facts. I love fun facts. I'm kind of a numbers geek, and I love it. So I've got a couple fun things here. And this was a new study done by Silvernest. I have no clue who they were, but my famed demographer, Neil Howe, who I really dial into because he's very, very good, exceptionally good, and articulates what's going on so well. He said that 88% of Americans age 55 and higher, which I'm not there yet. Next year I will be, want to stay in their homes as long as possible. That's kind of a no-brainer the way I look at it. In the past, think about a decade ago, the big thing was invest in senior living types of things. Look around Fort Collins, there's a ton of those things. What I always find interesting, the parking lot's always interesting. They're always looking for help. I'm not sure what that means, but the cool thing is now is people have the capacity and the capabilities of staying home as long as possible, and they should. This is fantastic. I just thought that was kind of a confirmation of a fun fact that I really already did know. The second one here is in 2020, the number from the CDC in American life expectancy at birth fell by 1.8 years to age 77. That means in 2019, it was 78.8. As of the close of last year, due to everyone dying from COVID, it dropped to 77. You know when the last time we had a higher number was? I'll let you think about that for a second here. I'll get another drink while you're thinking. 77 years ago. You know what was going on 77 years ago? World War II. And the decline was 2.9 years. Interesting, huh? Yep, COVID is fake. I get it. Anyway, closing it out here, and this is funny. And I'm going to try to clean this one up as much as possible because it just opens the door to be raunchy. And, between my wife and my mom, I'm trying not to be raunchy. I really am. I know sometimes they would debate that, but I'm really not. China, as many of you may have read, had a decline in birth rates. They actually probably did for the last couple of years. They lie about everything, so the numbers are probably much worse than what they finally reported. They have a decline in birth rates, okay? They've made changes such as they used to have the 1 child per couple policy. Well, they kicked that up to 3. They're trying to get people to procreate here. They're like, hey, it's such a great place to live. You need to make more babies. And you know what most people are saying? Up yours, it sucks here, and I don't want to have more babies. I'm sticking to 1. Another thing that they have done is they've begun to limit access to vasectomies. I said it, I did, the V word, vasectomy. Isn't that funny? To try to boost birth rates. The Washington Post went out and surveyed 18 major public hospitals across China. 12 of them no longer offered them. 6 of them said they still performed the surgery, and 1 said they no longer offer it to unmarried men, in which, if you look at the reported numbers from 2015 to 2019, they dropped from 149,432 vasectomies to 4,742. That is a big drop, and all I can say is a remedy for that is frozen peas. With that, I'm out. It's been great to see everyone. I'm excited about 2022. I hope you are too. Thanks for joining me today. And this is Craig Modelmach for Wall Street X's and O's. Cold peas again, and I am out. Later.